Welcome. My name is Kimberly Hendy, and I am one of the brokers and co-founders at South Cedar Real Estate. Thank you all for being here today. We're excited to have you join us, and we appreciate you taking the time to be with us this morning. I'd like to give a special thank you to all that helped get this event set up and organized. Katie Bowman from South Cedar Real Estate, Leona and Renee from Martinez Law, and Caitlin from NFM Lending. So thank you guys so much. We wouldn't be here without you guys. We have a great group of professionals with us this morning that are going to cover legal topics, real estate, and lending. And our hope is that they can provide some insight for us and answer some of the most common questions that we see in today's market. Thank you to everyone who submitted questions ahead of time. We're going to try our best to get through as many as we can this morning, but there will be some time at the end if you have additional questions or just want to connect with some of our panelists or continue networking. We would love for you to do that. Before we get started, I would like to have each of our panelists introduce themselves. We have Jane Floyd from NFM Lending. We have Greg Wilkerson from South Cedar Real Estate, and we have Kristen Martinez from Martinez Law.
Good morning, everyone, and thank you all so much for coming. And Greg, thanks for putting this on. It was your brilliant idea. And I'm Jane Floyd, as she said, with the Floyd Team Home Loans. And I have been serving clients for about 35 years. Our team has. So we've served over 7,000 clients, and just super excited here today to answer any questions and honored to be in front of you guys. So thank you.
Good morning, everyone. My name is Greg Wilkerson. I am one of the brokers at South Cedar with Kimberly. I'm a Tampa native, have lived here for going on 40 years now, minus a few years in college and law school. I'm also a licensed attorney. I practiced real estate law for about 7 or 8 years, right after the Great Recession, and so have seen the ups and downs of the real estate markets. We started off as an investing brokerage. We still do a lot of commercial investing, but we really rolled the idea of starting this brokerage and bringing on agents about 2 years ago and rebranded as South Cedar Real Estate, and have gone from, I think we were at 2 agents with James Lascara and I 2 years ago, and now we're up to over 20, so growing rapidly and looking to grow more. Excited to talk with everybody today and hope bring some clarity to questions that you have.
Good morning. My name is Kristen Martinez. I am the founding attorney at Martinez Law. I started the practice back in 2015. We do provide litigation and transactional legal services in the real estate space, but one of our big passions and my big passion is providing resources and education to the real estate community and real estate professionals. That's something that we have prioritized since the beginning days of the law firm. I'm not as smart as Greg, and I'm still practicing law, so I haven't gotten out of it yet, but very happy to share my insights with that perspective of being on the litigation side, because I see what gets people sued, what gets people in situations where they feel the need to sue another person, and so hopefully I can help you and your clients avoid those situations.
All right. Well, thank you, Jane and Greg and Kristen. With that, we'll go ahead and get started. The first question is, what are the most misunderstood timelines in the Florida contract, especially regarding inspections, financing, and escrow deposits?
So the biggest things when we're talking about buyers and sellers and the most misunderstood things is, the first one is that deadlines exist, that they are important, and that time is of the essence in the contract. Meaning, if a deadline is missed by an hour, that is a material breach of the contract. And again, clients, especially buyers, need to be very aware of this. With regard to, I'll start with the escrow deposit deadline. That is one big misconception that I see, is a lot of agents too believe that the making of that initial deposit into escrow is a requirement to form a binding contract. That is not true. The thought process behind this misconception is that initial deposit constitutes the consideration, which is a requirement to form a legal contract. Again, that is not true. Our FAR contracts are actually very clear in that a default exists when any deadline or any obligation is missed, including the buyer's obligation to make the escrow deposit timely. That's how we know that there is a fully binding and enforceable contract before that initial deposit is ever made. So It's extremely important for you and your clients to understand that and know that deadline usually is 2 or 3 days. Comes very quickly, especially if you're going under contract on a Friday or over a weekend. It can get tricky. So make sure that you're fully educating and staying on top of your buyers to get that done on time. With regard to the inspection period, the biggest thing that I see is the belief that so long as I am requesting repairs on behalf of my buyer, or buyer and seller are engaged in good faith negotiations over repairs, that inspection period deadline is somehow told or extended. It is not. So as a buyer and a buyer's agent, it is not really a great time a day or two before the expiration of that inspection period to start asking for repairs. Because while I think we all know a seller has no obligation to make repairs, a seller doesn't even have an obligation to respond to a repair request. So make sure again that you're fully educating your buyers on that. So if they do want to make repair requests, you're doing that timely. And I think the financing deadline was the last one. The biggest thing I see with this is buyers think, they don't read their contracts. So buyers think that if I get denied financing, I can cancel the contract and get my deposit back. That is not true. Only if they get denied financing, they get denied financing within the loan approval period and they communicate that in writing to the seller within that loan approval period, do they get to cancel the contract and get their deposit back. So a lot of times we see the closing date extended because of financing issues, but the loan approval period is not also extended. So the buyers think, I have more time to get my loan in order, and if it doesn't work out, I can cancel. And that ends up biting a lot of buyers in the rear end. So I promise my answers won't be this long going forward, but I don't know if you have anything to add.
Yeah, so I'd like to talk about some of this from the business perspective of a now former attorney. And so one of the things that I see a lot is, what is the actual effective date of a contract? And one of the essential factors to establish a contract is you have to have delivery. That is required. So if you're a buyer or you're a buyer's agent and you send over a fully executed, or you wait to send over a fully executed contract, let's say you execute it on a Friday, it's late, but you don't send it until the following day, your effective date does not start until that next day. And that needs to be clearly identified and communicated to the other side. They're like, hey, sorry, whatever, we waited to send this, it was late. Everybody needs to know when that effective date starts, because if you don't know when your timelines end. And if you don't know when your timelines end, then you're really compromising your client. So that's one thing that I see very often that people struggle with. I'd say one thing I always try to do with my contracts is not put, especially when I'm representing buyers, is, and I know you've talked about this online, is I don't like to put specific closing dates in an initial offer because, and here's my reasoning, and I'll use some timelines. Let's say we put an offer in on January 1st and I put a closing date of February 4th, which is about, 35 days. We go back and forth with counter offers, and then 7 days later we sign a contract. We have a 30-day financing contingency, but now we're at January 7th with a 30-day financing contingency we've executed, and our closing date is February 4th. How does that make sense? We've got contradicting terms in the contract. So what I always tell people is make it within a specified period, right? So that way you're pushing out the closing date as you're pushing out those negotiations and effective dates. So just make sure that you're aware of that, because you cannot have contradicting terms in a contract on day one.
Our next question is, what happens when there are liens, open permits, or unresolved code issues on a property the seller wants to sell?
One thing that gets sellers in trouble often is disclosure issues, specifically when it comes to permits. There is a specific and separate permits disclosure within the as-is contract that a lot of sellers don't realize. So can you sell a property with open permits or unpermitted work? Maybe, yeah. But if you are not disclosing that up front to the buyer, after closing, the buyer could sue the seller for whatever cost they've incurred to have to open up and properly close out permits. Sometimes that includes having to demolish unpermitted work and reconstruct it. So for listing agents, I think it's very important to discuss with your sellers, like, what is it going to take to get these issues resolved pre-listing, or agree to do it at least before any closing occurs. And if not, that's okay. Just know that our buyer pool may be very limited and we are going to have to disclose these issues.
I think from the buyer's perspective, if you're representing a buyer, you should have a form checklist that you are going through on day one or even prior to that says, hey, here's a list of due diligence that I have to do on every single property to make sure I protect my client. And I'll give a great example. We were dealing with a house in Riverside Heights about 18 months ago, and day one, I go in, I find a permit that was withdrawn by the seller. We start digging into it, and we find out that they put a structure on the front, but they didn't pull architectural plans and they didn't finalize the permit. And what happened? The city came out and red tagged in the middle of the contract. And they said, you need to come back out, you need to submit architectural plans, and you have to do this the right way. If our buyer had been left with that, they would have been left with the costs and the time and the effort dealing with undoing all of that mess. And what happens then? Like, there's lawsuits all over the place just waiting to come out against the broker, against the agent being pulled in. And let me clarify for everybody, they don't have to have a valid legal claim to file a lawsuit. Like, people are out there all the time filing claimless lawsuits, and you need to make sure you protect yourself because it can really come back.
Our next question, how should agents advise buyers on rate buy downs in today's market?
That's you.
Well, that's a great question. But first, I think that you should advise the buyers to talk to their lender. I stay in my lane, and I think here's what needs to be clarified. There are two different types of buy downs. There are permanent buy downs, and there are temporary buy downs. And everybody's situation is different. It's what's the ultimate goal of the buyer. So a permanent buy down is money spent to buy the interest rate down. And the key there is, what's the recoup period? So, for example, if you believe that interest rates are going to go down next year, it wouldn't make a lot of sense to advise a buyer to pay, 2 points to buy the rate down, because the recoup period on that could be anywhere from 4.5 to 5.5 years. However, if you don't believe that, or you have a buyer that literally, like, that payment, they cannot lay their head on the pillow if that payment isn't a certain amount, then it makes sense. So it's just doing the math, showing the graph, here's the cost, here's the recoup period, and this is what it means to you. Now, a temporary buy down is totally different. A temporary buy down, and what's most prevalent are the 2-1. So, for example, if rates today were at 6.5, and who knows what they are, it's been so violent the past 30 days that I can't even keep up. But so if rates today are at 6.5, and you want to do a 2-1 buy down to buy that interest rate down to 4.5 the first year, 5.5 the first year, 6.5 the second year, a buyer cannot pay that. So, for example, to ballpark 2.25 percentage points, a seller or a builder has to pay that. Now, here's what's important about that. You're not setting a buyer up for failure, because lenders, Fannie and Freddie, the agencies, require us to qualify that borrower at the end rate. And what else is cool about that is that, let's say rates drop down. That was the situation today. And let's say rates drop down in 1 year to 5.5, and the borrower wants to go ahead and lock that in because we think that's the bottom. That unused portion of the prepaid interest that the seller paid to buy the rate down for the borrower is credited. Not all lenders, but we do. Many do. That money is credited back to the buyer when they refinance against a principal reduction. So again, it really goes back to understanding what's important to that buyer.
All right, thanks, Jane. Our next question is, how should buyers properly sign contracts when purchasing through an LLC? Does the signature itself need to include the title, or can manager be listed beneath the signature?
Okay, so this is a big mistake that I see buyers and sellers and agents make often, is when your LLC or your corporate entity is the party to an agreement, a listing agreement, a purchase contract, any type of agreement. If you are signing just with your individual name, you are signing that contract in your individual capacity, meaning if there were any sort of breach of that contract or liability under that contract, both the entity named at the beginning of the contract and the person who signed, you individually, can both be held liable, can both be named in a lawsuit. So it sounds like a really small technical thing, but it's actually super important to sign in your capacity as whatever you are to that entity, the member of your LLC, the manager of your LLC, the president of your corporation. Whatever it says you are on SunBiz, that's what you should be signing as. So you always want to make sure of that, because in the eyes of the law, even if you are the sole owner of your own LLC, and I have Kristen Martinez LLC and Kristen Martinez is the sole owner, the law sees me and my LLC as two completely separate and distinct legal entities. Even though I know we're pretty much the same, the law doesn't see it that way. So I have to behave as though we are in fact completely separate and distinct if I want the benefit of the protections that that LLC or corporation provides. So the biggest thing that I see as far as piercing that corporate veil or allowing people to sue the individual owner of a corporate entity is signing in your individual capacity versus your capacity as owner, member, shareholder of your corporate entity.
And just on top of that, the as-is contract does not make it simple for doing this, right? Like, it doesn't have a signature block where you can go easily fill in. So just as an example, let's say I have Greg Wilkerson as the manager of ABC LLC. I should be signing it Greg Wilkerson signature, and then by Greg Wilkerson as manager for ABC LLC. It seems like you're redundant and going above and beyond, but really these are the things you should be doing to make sure to protect yourself or to protect your client.
All of that is if you're paying cash. So what a lot of agents, well, I am not an attorney, but I know Fannie guidelines.
Oh, caveat to all this, there's no legal advice here whatsoever.
Greg, you forgot to say
Yeah,
that.
I totally forgot, sorry.
Just to remind Greg to say that. No, I get this question all the time. Fannie and Freddie do not allow a loan to be closed in an LLC. There has to be a natural person. So now you can do a non-QM loan in an LLC. However, a lot of people don't know this, and it's only been since, I don't remember what month, but 2024. This is huge. Fannie and Freddie will allow, right after closing, for your client to transfer it into the LLC. Now, they're personally on the note, so it's guaranteed, obviously. But that's a big change because we get that question all the time. I had one yesterday. Can I close it in an LLC? Yeah, but you're going to pay a higher interest rate to go non-conforming. I don't want to pay a higher interest rate. Well, then you could do a trust, but you cannot close and sell a loan to Fannie or Freddie in an LLC.
All right, some good insight there. Thank you all. What impact do you think large brokerages acquiring smaller firms will have on the industry?
That's what you.
Okay, this is a loaded one. I mean, we're constantly, this is what we're constantly seeing right now. Obviously, Compass has been at the forefront of acquiring brokerages. I think they've called me 4 times in the last few months, which is a good sign for us. From the perspective of access to, and this is my subjective opinion, but I think if I look at this from an access to listings and the ability to buy a home, I think there's a major impact on buyers. Compass has been very upfront about and there may be some from Compass here, I don't know the official term for it, but they have their sort of in-house ability to share listings, and I do think that there may be some regulatory pressure in the future with people having, the way I see it and the way I view it is, in order to get access to those exclusive listings is you have to be working with a Compass broker. And look, I would do that too if I were them. There's an obvious angle, like they want to double side the transactions, but I think there could be regulatory pressure in the future. I do think that it makes it restrictive for buyers who, not every person needs a real estate agent. I mean, there are people that are qualified to do this, and they should use somebody that knows what they're doing, but there are always going to be people, and I think restricting home ownership and not, maybe that's not the right term, but I do think there is some restrictive nature to saying, hey, if you want access to our exclusive listing, come into Compass and come into this other brokerage. So I do think it impacts the ability for people to be able to buy homes. I think that's a major thing that has to be considered. I don't think that there's anything nefarious that's going on, but I do think from an outside view, that's the way I kind of see it, is like, you've got to be kind of in the door to be able to get access to this stuff.
Next question is, what are the key differences between the as-is contract and the standard Florida contract? And what legal protections do buyers and sellers potentially give up when using an as-is contract?
I think at a very basic level, the non-as-is contract, I will refer to it as that, does provide some more protections for buyers, right? Like, there's required states of the property that it has to be delivered in. If you look at, I believe it's 12B of that contract, it says, hey, the seller has to provide the following in working order, and they also have to maintain it in working order and deliver it in working order at closing. And there's a guarantee of repairs up to a certain amount. So when you look at the as-is contract, it really is basically a seller saying, hey, look, like, you have every right to inspect. You can come in and do what you want, and you can find any deficiencies, but like, you're taking it as is. Like, you are, when we get into these contracts, I think we all need to remember, as representing buyers, is like, we did sign an agreement that says we are taking this property as is. And so when you go to negotiate, you're asking them to do something that, really wasn't agreed upon at the onset of the contract. So I think that's the obvious major difference, is you are guaranteeing the ability to have repairs done, set within financial limits, and that the property will be delivered in a certain state.
I agree with all of that, and I think it's, as an agent, I think it's a huge mistake to, in every single transaction, no matter who the client is, the characteristics of the property, you're grabbing for a single contract every time without giving it a second thought. Right now, that's the as-is contract. I think that agents should educate yourselves in both versions of the contract, the standard and the as-is, because there are definite benefits to the as-is contract in certain situations, and then there's benefits to the standard contract in certain situations. For a buyer that is at the top of their budget, that their monthly mortgage payment and their taxes and insurance on all of that is really going to stretch them, who cannot afford to have a major repair happen in the months after closing, they may want to consider the standard contract. Buyers are also, I believe it's paragraph 18 of the as-is contract, are waiving their right to pursue the seller for anything regarding the physical condition of the property after closing. That is a huge waiver of rights in the as-is contract, which comes with no representations, no warranties, no nothing aside from your standard seller disclosure. That is a huge waiver of rights that buyers at least need to be aware of before deciding which contract is going to best suit them. I think buyers and a lot of buyers' agents are like, ooh, I just want the free look at the property. I just want that inspection period where I can get out for any reason or no reason at all. I can change my mind. And that's all they're focused on. That comes at a cost. That comes at the cost of a huge waiver of rights that many buyers aren't even aware of, because we know buyers aren't reading their contracts. So do yourselves and your clients a service by making sure you're educated in both contracts and when each contract is going to be most beneficial to that transaction.
What about when the listing agent puts, we're only accepting as is? Like, what choice do you have at that point?
I don't think that there's a requirement to, if you put an offer on the table that meets their criteria and is better than everybody else in terms of, financial terms and timing, like, you don't have an agreement with them that says, I have to submit this contract. Like, you have to do what's in, you cannot allow people on the other side to make decisions on behalf of your client. So they can say that all they want. We see this all the time with builders. They love doing that with the construction contracts. Unfortunately, sometimes they just say no, and you kind of have to do what you have to do. But if you think you have a strong offer and you think it may be accepted, I think I would be willing to submit it on the contract that my client is comfortable with. And from a business standpoint, we're supposed to be experts for our clients. If a client comes in and says, I think this is a great question that was asked, be able to identify for these clients which contract is the best one for them. Because otherwise you're going to fall flat-footed and you're going to be like, I actually don't. If a client asked you that and you said, I don't know, that's not a position you want to be in. So make sure you do read the contracts and understand them fully. I know it's time intensive and it's not the most fun stuff, but it is so important to making yourself an expert for your clients.
Question. So we at Polaire will use a spectrum contingency release document. We don't put arbitrary requests on an addendum. Is that correct?
I can see. Oh, I probably don't need a microphone. So the actual repairs to be completed by the seller is not specified in a contract document anywhere?
No, it's just an inspection contingency release that it has at the bottom, that your sellers to maintain property and, fit in the condition for the whatever paragraph, the paragraph 11 of the as is.
So if there are no repairs that the seller has to make, I think that's perfect. If there are repairs that the seller is expected to do prior to closing or sometime thereafter, I think it's a mistake not to make those part of the contract, because then the buyer doesn't have legal recourse, to address that or hold the seller liable for not performing those repairs. Because anything that's not within the four corners of your contract, a judge or a jury can't consider in awarding relief to the parties. So those repairs that were agreed to but aren't part of the contract documents could not be considered. Like, that agreement doesn't exist in the legal world.
All right, we probably have time for one more question. Why do some lenders request a broker compensation agreement even after the title company already has it? Is it actually required?
So it is not actually required. However, all underwriters are going to ask for it. You can refuse to give it, and we have had that happen. But the problem is we need to see it, because if your buyer is agreeing to that you will be paid 3%, and let's say the seller is only going to pay that 1%, you got a $700,000 loan, that's $14,000 that it's going to come out of their pocket. It could affect the reserves, it could affect the loan, and it could blow up last minute. So not required, but we always get it.
All right, great. Well, we
Couple
want to have some
questions.
hands.
On I asked that question. So on compensation, if a buyer agreement has already been signed with the seller, do you still need addendum GG attached to the contract to make that contract contingent? This has come back.
If the compensation agreement has already been signed,
Right, yes. So you're
then you do not need GG.
It's
GG is
redundant.
only when you're submitting your offer with an unexecuted compensation agreement.
I've seen some crazy stories with this one. I've seen experienced agents on both sides have strong opinions. Low appraisal with the financing contingency. So you standard 30-day financing contingency period, and if you're within that, on day 25, get the appraisal back, and it's low. Does that alone give a buyer the ability to back out the contract to retain their profit on the standardized?
So it can give the buyer the opportunity. So the language in that financing contingency portion of the contract provides for loan approval and an appraisal, I'm paraphrasing, satisfactory to the lender. So just because it doesn't appraise at the full purchase price doesn't necessarily mean that that appraisal won't be satisfactory to the lender. Let's say it's, they're only financing 50% of it, for example. So if that low appraisal does not satisfy the lender, meaning it's going to result in a loan approval not being issued, then that does give the buyer an out if they're within that loan approval period, but not necessarily. So I get that question a lot, like, do we need the appraisal contingency addendum when we now have it? Yes, you do, because the language in paragraph 8 of the contract, the financing contingency provision, is not a true appraisal contingency, certainly not for up to the purchase price. It's just whatever the lender is going to require to fund the loan.
So if I'm understanding correctly, if you did do the appraisal delinquency and the low appraisal caused the financing to not be approved, then they could be out even though they did not do an appraisal.
Correct.
But not always if it didn't result in disapproval.
Correct.
I mean, it's a really good question, James, and I honestly, from different legal counsels, have had different opinions. So if the borrower's putting down 50%, it's not going to affect the loan that they applied for. However, they applied for this loan with this amount down, that's what we are committing to from a lender standpoint. And if that appraisal comes in low, so now your LTV went from 50 to 70, that's not what they applied for. So technically, I've been advised we can turn that borrower down if they do not want to purchase it because they went into this with this certain LTV. But that's not what happens most of the time. Most of the time it's going to affect, now you're going to have PMI or you're not going to qualify for the loan. So it's a tough one.
And just to comment on that, I would make sure that if your buyer is not moving forward and your lender does deny them, make sure to get a formal denial. Like, make sure you get it in writing, in a document. And again, somebody can still dispute it on the other side, but if you go to court, you have a formal denial letter from your lender within that prescribed time period, the chances of them getting their deposit back are going to be much higher.
More from the investing and development perspective, we've bought a lot of teardowns the last year and a half, and we've gotten ourselves into situations where we have like some pretty crazy, sometimes post-closing occupancy agreements. My aim is typically where like the penalty for not abiding by the terms of the post-closing is so painful that they will abide by it. My question is this: is there a way for having the owner pre-sign the release so that if they don't abide by it, whatever, 60 days later, and now we have to collect on that because now we face like real eviction costs, is there a way to do it in advance at the signing of the post-closing agreement, post-closing occupancy agreement, so that later don't have to collect a signature, which they'll probably fail to provide?
Meaning to release escrow funds?
Yeah, like pre-authorizing,
Right.
you need to have the unilateral discretion to say, it's 60 days, they did do their part, I'm collecting it, I don't need theirs.
Most title companies are not going to accept that. It is within the title company's discretion to determine whether they're comfortable accepting a pre-signed release of escrow monies. I would not accept it in my title company. There might be some that will. But that's going to be up to the title company as far as whether they accept that. In my experience, that will probably be hard to find because things can come up, right? So the occupant, the buyer can be like, well, the seller breached their contractual obligation, so that negates this prior signed thing. And the title company is going to be like, I can't make a legal determination. There's not always a good legal argument to come up with, but there's always a legal argument that can be made where it's not as clear cut as you would think it would be just because it's pre-signed. Like, people come to me all the time, inspection period expires, it's a cash transaction, and the buyer canceled. It is so black and white, why won't the title company release it? Because there are so many there might be defenses that there was no enforceable contract to begin with, to even get to that. Like, there's so many things that can be argued in court that I don't think a title company would accept that. But I mean, you can ask around, it is within their discretion.
From a business perspective, you think about a title company, are they really going to risk their licensing for your $10,000 escrow? I mean, it's just not worth it to them. It's like, hey, I'm just going to go let you two go figure it out. And when it's settled and you have a signed agreement or a court order, then we'll release it.
All right. Well, that concludes our panel this morning. Thank you all for being here today and asking such great questions. Thank you to our panelists for sharing your expertise and insight on these topics. All right. Thank you, everyone.